All right, so hello everybody. My name is Erin Spiropoulos, and I will be the moderator for today's webinar, which is the first out of our series of webinars. I would like to thank you all for coming and would like you all to know that we will be recording the webinar. So if you have not seen the pop-up come up yet and you wish not to be recorded, please click no. To quickly go over today's agenda, I have a short introduction video for you all, and then I will be introducing our guest speakers who will be discussing the VCA ecosystem and debt lending platforms. At the end of the presentation, we will be answering questions. Therefore, if any come to mind during the presentation, please drop them in the chat box. So without further ado, I will begin our video.
Value Creation Alternative is a strategy and investment advisory firm.
We help companies develop their business through acquisitions, organic growth, and digitalization.
We accompany our clients throughout the entire life cycle of their corporate development program, strategy definition, target search, due diligence, negotiation, transformation map, change management, and digitalization.
We are a worldwide network of more than 1,000 seasoned professionals with more than 35,000 contacts and have collectively advised M&A projects worth in excess of $100 billion.
We support complex strategic and operational business decisions with deep analysis and robust processes.
Our methodology is a combination of desk research, interviews, and application of our internal know-how.
We are the link between buyers and sellers of companies, private equity, debt, commodities, and other asset classes. And so today we will be welcoming our webinar speakers, Mr. Christophe Schwoertzig and Mr. Paul Leitao. Christophe is the founder and managing director of Value Creation Alternative, or VCA. He is also a non-executive director of FitzCorp, a regulated corporate structuring and advisory investment funds, securitization, and M&A company, as well as financial director of the Council for Trade and Investment Promotion, a non-for-profit organization headquartered in New Jersey. Prior to setting up VCA, he worked for an IBM agency as an IT director and as managing consultant at Accenture, Capgemini, Ernst & Young, and Cannon Eagle, a strategy consulting firm in London. Christophe is trilingual, speaking French, Spanish, and English. He has worked and lived in France, Spain, the UK, Switzerland, the US, Chile, and Ireland. He holds an MBA from IESE Business School and did his exchange at the London Business School. He also holds an engineering degree from the National Institute of Applied Sciences in France, a French grande école. Mr. Paul Leitao began his career in the City of London as a stockbroker with Interactive Brokers, a US-based retail and institutional shares and derivatives broker. He then transitioned to Sungar Trading and Polium Asset Management as a fund executive. Paul left his City career and set up Macario Capital as a corporate finance firm, helping European companies in fundraising and financial engineering. He is currently a finance broker working in partnership with lenders and borrowers across 5 continents. He holds a bachelor's in hotel management from HIM Montreux in Switzerland and is currently pursuing a PhD in economics at Warsaw Management University. So without further ado, I'm going to put Christophe Schwoertzig into the spotlight so he may now present on the VCA ecosystem.
Thank you, Erin, for the introduction. As explained in the short video, VCA is a corporate advisory firm. We help companies develop their business through M&A, fundraising, and strategy consulting. Now, what makes us different from any other consulting firm? Our unique selling proposition is our collaborative network. Our collaborative network, it is more than 1,200 VCA members with more than 35,000 contacts, of which around 5,000 are investors. But our network is also an ecosystem of ready-to-go solutions to help our clients hit the ground running. The slide that I'm sharing can also be found on our website in the menu Services, Solutions, VCA Ecosystem. Before I drill down into each of the boxes of the diagram, it is important for the audience to understand that our ecosystem is in constant evolution. We operate in the alternative markets and are always looking for out-of-the-box solutions. Our clients typically come to us when the traditional banks or financial institutions deny their credit applications. The good thing about alternative investors is that they tend to take on more risk than traditional institutions. The downside is that their reach is limited both in terms of time and size. Time is of the essence. So back to our ecosystem. We call ecosystem the structure that we are building to help investors acquire assets, and vice versa, help asset owners to find investors. On the left-hand side, you can see the investors broken down by types of investors. We are always looking to add new investors to our VCA network. On the right-hand side, you can see the assets broken down by asset classes. We focus on cross-border transactions in excess of $10 million. So we typically shy away from early-stage startups, but we can work with bigger startups through private equity funds and corporates as add-ons to large organizations or as suppliers of services. Some of our members are also brokering pre-IPO stocks, mainly unicorn stocks. Our objective is to cover the whole spectrum of the potential demand from greenfield projects to listed securities passing through private equities. The blue area on the diagram is our ecosystem as it stands today. Each box represents either a company or a group of companies with which we have built and developed 8 partnerships to deliver the services. The backbone of our VCA ecosystem is our CCAV in Malta. The CCAV is set up as a professional investors fund, which allows us to create and manage segregated sub-funds without going through the lengthy and cumbersome regulatory process. With our CCAV, we have 2 objectives. First, to create as many sub-funds as possible to invest in as many asset classes as possible. Second, to use the deal flow of the sub-funds to uncover potential clients. At the moment, we're in talks with fund managers and investors to create funds in real estate, gaming, marketing, medtech, pre-IPOs, foreign exchange, cryptos, and we even have a project for an artworks fund to manage the collection of the artist Salvador Dali. We shall run another webinar to explain that structure more in details in the coming weeks. Given that our CCAV is regulated, only authorized investors can invest into our funds. The good news is that having a regulated vehicle enables us to address institutional investors like banks and pension funds with deep pockets. The downside is that those institutional investors tend to be risk averse, whereas our projects command higher risk profiles. To overcome that issue, we have teamed up with a group of companies to raise funding from crypto investors. Our solution is a turnkey solution and includes not only the issuance of the tokens, service which is offered by lots of IT providers, but also the placement of the securities. The way we do it is by rating the securities that we issue through our digital rating agency, and then sell them through a network of independent financial advisors in France and Switzerland. Our IFAs are regulated by the AMF, the French regulator. AMF stands for Autorité des Marchés Financiers. We also have an AML/CFT license in Sweden to take cryptos in custody and offer an APY, an annual percentage yield, for staking and lending cryptocurrencies. AML/CFT stands for anti-money laundering / combating the financing of terrorism. Our unique selling proposition is to offer a dual income model to security token holders. One income is generated by the underlying assets securitized, and a second income is derived from the staking of the tokens, typically as a fixed income. Moving to the securitization platform box. We currently have two securitization platforms, one in Luxembourg and one in the Seychelles, both ready to issue corporate bonds. Our unique selling proposition is to offer credit enhancements in addition to the bond issuance to increase the bond's credit rating and therefore its marketability. Indeed, there is no point in issuing a bond if you cannot sell it. We have several credit enhancers from solutions from $5 million up to hundreds of millions, but there is an upfront cost that can range from $1 million to 25% of the bond face value. Let's go to the IPO platform box. Our IPO platform is currently focusing on US-based companies, but we should shortly be in a position to offer a solution to non-US companies. The platform is using US Security Exchange Commission Rule 506B to pool several pre-IPO companies and syndicate the cost of going public. The idea is to enable the platform to solicit the same investors on behalf of several targets at the same time, reducing de facto the fundraising cost. Our public-private partnership platform is the Council for Trade and Investment Promotion, or CTIP. CTIP is a non-for-profit organization. CTIP focuses on public-private partnerships, which tend to be large infrastructure projects in emerging countries. CTIP's modus operandi is to monetize credit guarantees issued by import-export credit agencies. We have a privileged relationship with Sinosure, the Chinese import-export credit agency. Sinosure can fund up to 85% of the projects. Our challenge is to find the remaining 15%. To raise the remaining 15%, we typically look for equity investors. In so doing, we have executed some sort of reverse takeover of Zysex, a US-based company listed on Pink Sheet, to raise equity through the issuance of public stocks. We also have an agreement to acquire part of Sapel International Bank to issue guarantees for surety bonds, which is particularly useful when the project is funded by a government. Through CTIP, we have a thick pipeline of hospital, roads, and other real estate projects in more than 42 jurisdictions worth in excess of $300 million. And last but not least, our debt platform. To talk about our debt platform, I'm handing over to Paul, who is sourcing some of our international lenders. Paul, you have the floor.
All right, Paul, I'm putting you into the spotlight right now, so you may present.
Thank you very much, Christophe, and thank you, Anne. So we are going to cover the basic types of debt finance. There are a diversity of instruments, debt instruments out there, but we're just going to cover briefly the three basic types. So cash flow debt, asset-based debt, and unsecured debt. Cash flow debt is a type of debt finance which focuses on the historic and current affordability of a business, not on future projections. So it's secured on the presumed ability to repay of that business and its cash flow affordability as it is. It can only be used in established trading businesses. It's not suitable for early stage or pre-revenue businesses. It is only suitable for cash flow positive profit-making businesses, although it may exceptionally be used for loss-making businesses. Asset-based debt is a bit different. It focuses on the nature of the assets being financed, as an example, vehicles and machinery, and is mainly secured on the asset being financed. That is the main source of security. It can only be used like cash flow debt on established trading businesses and like cash flow debt, which it doesn't really work with pre-revenue or early stage businesses. It's typically only suitable for cash flow positive profit-making businesses. It may potentially be used in loss-making businesses, okay? And finally, one of the most interesting of the three today, unsecured debt. So unsecured debt has a different approach. It focuses on the strength of the balance sheet being financed of the business. That is the main source of security. I mean, it requires no hard security. It doesn't require charges or liens or debentures on the balance sheet. And again, it could only be used in established trading businesses, not again, such as asset-based and cash flow finance. It's not really suitable for early stage, and is exclusively suitable for cash flow positive, profit-making businesses in exclusivity. Erin, if we could move on to the next slide, please. Erin?
Yep.
If we can move to the, okay, so we're just going to spend 2 minutes going over the basic types of debt and a few additional points. So the two basic types of debt are called senior and junior. So senior debt is financial jargon for debt which gets paid first above all other types of finance in the capital stack in the event of bankruptcy. So that is senior to all other instruments. Junior debt is it's also debt finance. So it has some kind of security, but it ranks under senior debt. So the way it gets paid, if in the event of bankruptcy, is it will get paid after senior debt, but above other types of finance, such as typically equity. And just a few additional points. So the difference between VC alternative and the banking, the traditional banking types of financing, is that, as I'm sure most of the audience will understand, banking finance has gone through a lot of changes in the last couple of years, and it's typically now just legacy. It's mostly associated with legacy thinking. So very conservative. Banks are typically not allowed to go to do much. So the regulators are on their heels to make sure that they don't do adventurous stuff. Basically, that's the bottom line. And at VC Alternative, we'll give the members other types of finance which are completely out of the banking system. They're still financial institutions, but they're not going to be banking underwriting logic. Okay, so that's a big competitive advantage for growth companies. Our geographical scope is mainly Europe, UK, and North America. It is possible to do financing beyond these regions, but the main focus is in these three regions. And just a final housekeeping about, which I'm pretty sure that most of the audience will be familiar with, but just to put the point across. So the difference between equity and debt. So equity is a risk-bearing instrument. So it's a type of financing which is there to absorb risk, whereas debt financing is not there to absorb risk, as we've seen from the short presentation. It's there either because there's affordability, financial performance, assets as security, or a very strong balance sheet. Thank you very much. I'll then hand over back to Erin and Christophe.
Well, thank you so much for that, Paul. So during the presentation, we did have a few questions come on in. And so I'm going to address the first question to Christophe. How would someone engage with VCA? And let me put you on into the spotlight.
Okay, thank you, Erin, for the question. Well, at VCA, we blur the distinction between clients and suppliers to favor collaboration. The initial contact can be via our website for companies or project developers looking for help. One can send a message through our contact form in the menu Contact. For individuals interested in joining the network, one can register directly as a VCA member using the Sign Up menu. Do not forget to check the opt-in toggle box to comply with the GDPR law. Remember, VCA members are organized as a pyramid. It is free to register, and there is no requirement to register as a broker. Those registering as investors will have to go through our compliance procedure, which consists in submitting a KYC/KYB and a proof of funds for compliance purposes. Those registering as agents are expected to submit opportunities to the network from time to time. VCA agents are our sales force. Subject matter experts are offering their expertise. Please use the comments box to explain what you're up to, what your expertise is, and the reasons for joining. We follow up with those who register as investors and agents on a case-by-case basis. Active VCA agents can eventually be invited to join as VCA associate directors. We are around 20-ish associate directors. Associate directors need to pass VCA onboarding compliance process. To manage expectations, only one candidate out of 20 applicants make it to directorship. Associate directors can operate under the VCA brand, so we apply a strict selection process. To access our VCA M&A suite, which is the CRM that manages the network, VCA associate directors need to be promoted to partners. VCA partners have access to the VCA suite, but need to contribute to VCA expenses. It is not free to become a partner. Opportunities are currently submitted to the network by emails, but we have plans to develop an online marketplace where each VCA member will be able to post his opportunities in the future.
Well, great. Thank you so much, Christophe, for that. And then I'm going to address my next question over to Paul. And I'm going to bring you on over to the front. Paul, what type of companies can be funded with debt?
Yeah, that's a very good question. So it's a mix of criteria. I mean, you could have in a mix either the affordability to repay, so a very profitable company, plenty of ability to repay debt. You could have good financial performance. You could have a lot of assets, so tangible assets, including property, or balance sheet strength. So it's a mix of, it's like a trio of these three criteria in combination. And ideally, you want to see these parameters in balance, because whenever there's an imbalance towards one criteria only, that typically restrains finance eligibility. But typically, affordability, good financial performance, assets, and balance sheet strength.
Okay, thank you so much for that, Paul. And then I'm going to go back to Christophe. Why would someone want to join the VCA network?
Well, why would someone want to join the VCA network? Well, VCA members receive curated opportunities based on their profile. VCA members' profile can be customized individually using VCA members' personal link. VCA members are rewarded based on their contribution to the network. We offer introduction fees and other types of fees for services delivered. Fee sharing is negotiated on a case-by-case basis. But as a starting point, VCA members shall get 10% for a successful introduction, 25% to contribute to the closing, 50% on joint ventures, and up to 80% if they bring a lead and deliver the work. So there are many reasons for joining VCA. Potential clients might be interested in joining VCA to partake in the closing of the transaction. Employees in established M&A, financial institutions, and consulting firms may be interested in joining VCA to uncover counterparties. Boutiques and smaller firms who typically operate locally might be interested in joining to leverage the network for cross-border transactions. Some are joining the network to generate a side income through deal brokering. One might be interested in joining to operate under the VCA brand and avoid the hassle and risk of starting one's own venture. I would recommend to read the post on our blog entitled "Why Join Value Creation Alternative?" where that question is addressed.
All right, thank you, Christophe. And then I'm going to bring it back to Paul. Can you finance an already leveraged company?
Yeah, can you hear me? Can you hear me okay?
Yep.
Yeah, okay. Yeah, I mean, that's again a good question. So the short answer is yes, we can leverage, we can finance an already leveraged company. I mean, leverage is a bit of a misnomer these days. Sometimes leverage expression is used where debt is used, but there are certain kinds of senior debt which can actually deleverage. So it depends on the details of each case, obviously, but the short answer is yes. We can take an already leveraged business with charges, with liens from banking, from banks, from the banking system, and we can put on additional finance to deleverage or refinance.
All right, thank you so much, Paul. And so I do have a few more questions that are coming through. So from Abel, thank you for your question. He asked, which of the funding apply to Africa? And then in addition to that, does the Africa market is restricted from some available investors or investments?
Christophe, do you want to take that one?
Okay, so most of our deals in Africa are channeled through the CTIP, the Council for Trade and Investment Promotion. And the truth is that the African continent is not an easy continent to deal with. With CTIP, we have a solution to fund large infrastructure projects. It is more difficult, to fund smaller projects or smaller deals. As I mentioned, for large infrastructure projects, we work with Sinusure, the Chinese Import-Export Agency, and we monetize those credit guarantees. For other deals, what we can eventually do is, if there is for example, a trade or another party outside of Africa, what we can try to do is that we can try to get that third party to issue an SBLC, a standby letter of credit, and then monetize that standby letter of credit. We currently have a deal with the RDC, the Republic of Congo, and they're shipping copper to Spain. And we've managed, to fund this deal because the Spanish company is actually providing its buyer's guarantee as a collateral. For funding, the issue that we have is that we need to have a strong collateral, and the collateral in Africa are perceived as being very high risk collaterals, and a lot of lenders are actually not accepting them. So can we find funding for Africa? The answer is yes, we can, but it tends to be, we really need to have very specific projects where we're going to build some sort of assets, and we go through project finance.
All right, thank you, Christophe. And then I did receive a question from Samir. Thank you for your question. And it asks, does VCA also raise or invest equity for infrastructure projects aside from offering debt solutions? And if so, what are the criteria?
Okay, so aside from, well, that seminar is more focused on the debt side, but so I'm just going to answer very quickly. We can also do equity raise. The dynamic of an equity raise is different from a debt raise. The profile of an equity investor is completely different from, the mindset of the equity investor is very different from the mindset of a debt investor. A lot of our debt investors also will invest into multiple projects, whereas the equity investor, especially for smaller deals, will tend to be really focusing on a very specific type of deals. So when it comes to equity investments, we need to work on a case-by-case basis and go through a very well-established process, which consists in, writing an information memorandum or a pitch book, putting together a teaser, and then we will cherry pick amounts, or database of more than 5,000 investors, those who have a potential profile, to fit the typical investment. So it is a lengthy process, and we typically would want to charge a retainer to do that work, because there is a lot of work upfront that needs to be done for equity investments.
All right, great, thank you. And then from Sten, we received the question of, in addition to the previous one, is there any fundraising opportunities for startups or pre-venture?
Okay, so way back to the equity question there, because startups typically command an equity investment, because as startups, they're not established companies, and therefore we cannot go for the debt because there's no collateral and there's no positive cash flow and so on. So as I mentioned at the beginning of the session, we tend to shy away from early stage startups because we focus on cross-border transactions. So for transactions below 10 million, it is very difficult to interest an investor to invest 500,000 into a startup. What we do and what we have in mind is to set up funds which in turn will be investing into startups. So at the moment, we are trying to gather multiple potential fund managers who are currently managing accelerators or incubators, already have some sort of portfolio of startups, get them to transfer the startups into a fund, and then we will raise additional money to put into this fund and basically help grow the portfolio. So at the moment, it's still too early stage for us, to invest directly into startups. In the future, we hope that we will have some private equity funds focusing on startups.
Okay, great. And then we had another question come on in, and this is from Daniel. How is the situation with regards to the risk of collaterals in the country's ASEAN, Association of Southeast Asian Nations? Is it possible to finance projects? And if so, what type of projects?
Okay. Is it possible to finance the projects? The answer again is yes, but not all the projects. We will typically focus on projects which are asset rich, right? So that we can look at the asset and see if we can find some sort of debt, asset-based lending for those projects. The problem of the country is it depends on each country and each jurisdiction. And if some investors will tend to shy away from specific jurisdictions, others, will not even consider it. So the type of projects that can typically be financed are those that are going to build very tangible assets, real estate, infrastructure, eventually telecom projects. If the project is a bit more like fluffy, like marketing or legal services or consulting services or startups, it's for us, at least it is very complicated. Now what we do is the same as before. We can see if we can find some sort of encore in a different country and fund this project, from the encore country, and then transfer the funds to Asia. And that's what we're doing typically with our CCAF in Malta. We raise the money into the CCAF, but then that's the funds, right, can invest anywhere in the world, right, or nearly anywhere in the world. But there are some countries which are blacklisted, but the location where you raise the money and the location where you're going to spend the money can be two different things. So we have to look on a case-by-case basis, but typically it's more complicated.
Alrighty, and then we have another one coming in, and then Xavier said, and for first-time funds.
Yeah, so for first-time funds, our methodology is to, what we offer the structure for the fund, right? So we have a team, we have the investment committee, we have the board of directors, we have the anti-money laundering compliance officer, the auditor, and etc. We have everything in place to hit the ground running. However, the fund manager, we need the fund manager. So for every fund focusing on a very specific class of assets, the fund manager, the client needs to be the fund manager. So the fund manager will bring his expertise for the investment into this specific class of assets. So our modus operandi is, instead of trying to raise money to acquire the assets, we look at fund managers or managers who already have a portfolio of assets. Then we take those assets, we transfer the ownership of the assets into the funds, and we consider these assets as a first tranche of equity into the fund. That way, our first-time fund doesn't look like a first-time fund, because it looks like we already have some references. So the references can be built elsewhere. It doesn't need to come from a fund. So for example, someone would have, 2 or 3 hotels because they acquire those hotels, they transfer the hotels into the fund, and all of a sudden you have a fund investing into hotels with already 3 references. This is basically the modus operandi that we have for the first-time funds.
Okay, great. And then so I'm going to actually make this one our last question, since we are coming close up to our time. So do you have a framework for VCA members to contribute expertise to a transaction, its structuring or its due diligence, for example?
Do we have a framework for VCA members to contribute expertise to a transaction, its structuring or its due diligence? Okay. We don't have a framework. We have dozens of frameworks. Every deal is different. And what we're looking to provide, we're looking to provide out-of-the-box solutions. So we don't have plain vanilla solutions, right? You go to a bank and you ask for a mortgage for your flat, and the bank will have a pre-established contract, and that's what they will offer. This is not how we operate. We operate across the board, cross debt equity, cross locations. We try to bring together the different pieces of a jigsaw to make it happen. So to make that happen, we tap into multiple boxes. This is our ecosystem. We have multiple boxes. Depending, we need to do an analysis on the risk profile. Typically, when you need to fund a project, you have several layers of risk. The most complicated layer of risk to start with is the initial investments. You know, the first investor is always the most difficult to get. The initial investors tend to be an equity investor. So it doesn't need to be an equity investor, but you know, it's more likely to be an equity investor because of the risk. Then as we start, you know, building the project, then we can add, you know, additional layers and move from equity more into debt, you know, so, you know, senior debt and then more and more junior debt. For each of these layers, I mean, we have a different framework. So what we do is that we're corporate advisory. What we do is it's handcrafting solutions. So yeah, so the answer is yes, we have multiple frameworks, but at the end, each project is unique and we need to provide a unique solution.
All right, great. Thank you so much, Christophe, for that answer. So I'm going to bring myself back to the front. I would like to thank everyone again today for coming to our webinar. If you have any questions that I were not able to answer or get to today, or if any come to mind later on, please feel free to reach out to me to my email attached above, esporopoulos@vc-alternative.com. And if you'd like any more information about what we've discussed today, please check out our website. There's a bunch more information on there. And with all that being said, thank you again, and I hope everyone has a great rest of their afternoon.
Thank you, Erin. Thank you, Paul.
Thank you, everyone. Thank you.